Yeah, so this is the one that I would say everybody is familiar about or have, an understanding to a degree in terms of how this works. But as any startup scale up, you will then go out at some point from that realm of being bootstrapped as an organization to go out and get external funding. And essentially, what also comes with that is a better network, as well as potential better expertise that organizations or individuals can bring into that business to aid its future growth. So, venture funding really comes at a multitude of different stages. You'll typically start to see organizations, and you've probably seen this through different wordings or descriptions in terms of what the funding is. So typically what you'll see is in the early stages, you'll perhaps see a seed fund, which may be, quite a small amount of money, but with a very small business. So that money starts to stretch a little bit further than you would imagine. You would then go up to a venture round, which would typically be then with a early stage VC, or venture capitalist injecting money. So a VC, just for clarity on that as well, tend to invest more so within the early startup organizations within a business. And then typically we'll then move into what is known as a Series A investment. So that realistically, that is that company's first real injection of cash. This is often where you'll start to see these values of money start to stretch into the millions, and that obviously starts to aid, serious growth. But with that, actually what comes off the back is, big heavy influence from a venture capitalist in terms of expected targets, for the next year, over the next 12, 24, 36 months. Because ultimately, what they're doing here is they're risking their own capital. And what they're doing is, again, buying into the futuristic or the future of that organization. And ultimately, they want to get their returns. So typically, what you'll see here is a valuation then based on this business, and that will vary massively, and that will also change with the markets. So I think, SaaS organizations this year, they've been looking at around 11 times valuation. So what that looks at is actually, the ARR that is within the organization, so their annual recurring revenue, and they'll look at them valuating that business at 11 times that value. So this is where you can then start to see that growth, and expectation in terms of, okay, if that company was going to be bought, this is now what that is now valued at and what it is worth. As we start to move on from Series A, these volumes or values of money will increase dramatically. So this is where you'll start to see your Series A, Series Bs, Cs, Ds, E, F, Gs, and some of them will go even on further past that. But where the real difference is here now is typically an organization will start to move into more of a profitability model. But this is where you'll often get PE firms starting to step in. So those are private equity. They are generally a lot bigger, and what they're doing is investing in a multitude of businesses and essentially, spanning their risk opportunities across multiple different organizations. So at the end of the day, they may invest in 20 and one makes it, but that one then, in terms of the money that they put in, is worth 10, 11, 20 times the initial value that they have put in. So again, as we start to go through these stages, as I said, through Series A, B, C, etc., this is then where those quantities of money will increase incrementally throughout those stages as well. But these big investments of cash, I say, come with a lot of expectations, a lot of pressures from outside influences. But ultimately, they're the injections of cash that an organization needs to really stretch and move through its business cycle.